version this time. Okay, looks like we're recording now. Okay, so again, thanks everyone for joining today. I'm Alex Olson, a Senior Research Associate at the Center for Analytics and AI Engineering. We're welcoming Quentin Bartram. He's a quantitative research team lead at Morningstar. At Morningstar, Quentin works in a number of areas related to machine learning and analytics. He's led impactful projects on work like anomaly detection and the development of AI tools for enhancing operational efficiency. Today, the talk is called Anomaly Detection, What to Do Without Enough Data. Quentin's going to share strategies for identifying anomalies in managed investment products when data is scarce. He'll cover both supervised and unsupervised machine learning techniques, and hopefully touch on ensemble models and rule-based approaches. And with that, I'm going to pass it over to Quentin.
Yeah, thanks so much, Alex. Like Alex mentioned, my name is Quentin Bartram. I'm a quantitative research team lead at Morningstar, and happy Halloween, everyone. So real quick, can just go ahead and hop into things. A little bit about me. So in that top corner is me and my fiance. Recently got engaged at the end of August, so super exciting. I'm from Columbus, Ohio, and attended Monmouth College, which is in the middle of some cornfields in Illinois. But was a great place because ultimately it meant that I ended up here. And so I got to join the Morningstar Development Program, where I started out as an associate quantitative research analyst and then had the opportunity to grow into a quant analyst role and now into this team lead role, where I get to work with a lot of our MVPs. This was this picture in the bottom corner is me yesterday leading trivia. I was Steve Harvey. And then these are my dogs, Lily and Paco. Cute as can be, as hopefully you can see. But today, yeah, we're going to be talking about a couple different things. So first, I want to give you guys a little bit of background at Morningstar. And actually, before I get too deep into things, feel free to interrupt me and ask questions if you have them. I know I'm pretty bad at interrupting people, so I don't get offended. Totally fine. But back to this. Like I said, we'll give a little bit of a background at Morningstar, really help kind of paint the context for this anomaly detection project, talk a little bit about some of the different approaches that we've tried with this specific anomaly detection model, and then we'll talk about a couple of events, manager change here, and some performance type anomalies to give you an idea of what we actually implemented. So going ahead and just hopping into things. Brief history of Morningstar. 40 years of empowering investor success. And so I think it's important before we get into Morningstar specific history that we just cover quickly what a mutual fund actually is, since Morningstar was founded to help demystify mutual funds for investors by Joe Mansueto. So a mutual fund is an investment vehicle that pulls money from multiple investors to purchase some diversified portfolio of stocks. It could be bonds or various other securities. You could think of, if anyone's familiar with the S&P 500, that's the 500 largest companies in the U.S. That create some portfolio that you could then invest in. And the first modern mutual fund actually came out in 1924, and then there's about 60 years between that 1924 to this 1984. So what was happening in that time was a lot of institutional investors were getting access to these funds and investing in them. But for your average investor, who's maybe saving for college for their kids or something like that, didn't necessarily have the same access to that data. And that meant that they weren't as well informed. And so Joe Mansueto, who was a stock analyst at the time, recognized that this kind of hole in the market existed, and so founded Morningstar for the sake of demystifying mutual funds for your average investor, as well as institutional investors to some degree. And that actually comes to the first Morningstar product that was released in 1984 as well, the mutual fund source book. The basic idea here that it provides data on mutual funds. Jumping forward only a year, the first Morningstar rating for funds releases, sometimes called our star rating. Now, the star rating is important for a number of reasons, but the specific thing that I'll talk about just quickly is that this star rating is rated 1 through 5 stars, 5 stars being the best, one being the worst. And this is essentially a more complex calculation, but ranking historical returns. And if you're in the top bucket, you get 5 stars. If you're in the lowest bucket, you get one, so on and so forth. I'm actually going to skip over this one. It's not as relevant to the talk anymore. Happy to answer questions if you have any about the Morningstar style box. But really, between 1985 and 2011, there was this recognition, and I mean, broadly, it's recognized that previous returns, so how well a fund does at some point, does not necessarily mean that it will perform well in the future. So already, this only being backwards looking is somewhat limiting toward to investors who want to be able to predict future outcomes, right? And so that's when the Morningstar analyst rating first was released. And the focus here was, like I said, a forward-looking rating that we can then use to predict future returns. And that hit the market pretty well. In 2017, the Morningstar quantitative rating comes out. And so really what the quantitative rating sought to do was take all of this information that the analyst rating had provided us over time and apply random forest models and post-processing to that to be able to cover not 30,000 funds, but about 400,000. With strong efficacy with that, we were then able to actually combine these two ratings into the Morningstar Medalist rating. This last year, I think it released in July. Then finally, that kind of sets the groundwork for this managed investment anomaly detection. So we have this system that rates funds, but recognizing some of the structure of how the analyst rating is done, anomalies may be, detecting anomalies is very important to ensure that the rating that we provided at a point in time remains consistent. So that actually helps me set the groundwork for the overview of anomaly detection. And so I really want to start with just a little bit more background, I know. But obviously anomaly detection is this process of identifying data points that are outside of norm or what is expected, also called outlier detection. But really what we needed to do was we needed to figure out what are we going to detect anomalies on, right? So there's this concept, like this idea that it could be helpful to detect anomalies on funds that our analysts are rating. What should we even think about trying to detect? And really what we do is we dive into the medalist rating methodology a little bit, and we see that that rating is actually based on three pillars: parent, people, and process. Parent is the firm that actually releases that fund. People would be the individual portfolio managers responsible for that. And process is ultimately that investment process that they're following, right? And so these fall into two larger buckets, which is the fund or a strategy level, and then this parent or firm level. So if we can detect anomalies in these two buckets, then ideally we can say if no anomalies have occurred, then this rating is consistent and we can maintain it. And then this gets now into the analyst review schedule, right? So an analyst that rates a fund will re-review that fund about every 12 months. In some cases, this is shifting to 18 months, though, and especially since it's longer in between actually rating these funds, uh, we need to have this system in place for that purpose. Um, and then the parent and firms are rated every 24 months, so even more of a reason to have the ability to detect anomalies on this. And then quantitatively rated funds are actually re-reviewed every month. So for the most part, anomaly detection doesn't necessarily fit for that portion of medalist rating. So really what we wanted to hone in on is those 30,000 analyst rated funds or strategies. So that way we can ensure on a regular basis that these ratings are consistent with what our view actually is. And then the last thing I'll call out is an analyst does have the ability to review a fund at any point in time. It doesn't have to be 18 months, right? So we have these off schedule reviews that would be caused by anomaly events. Now, there's a number of issues with just this off schedule review. So the off schedule review in concept is a very good idea, right? That means that we are only actually reviewing things if something occurs. But to this point, it's only ever been initiated by the analyst, right? So one of our goals with anomaly detection was specifically to alert analysts to review these specific changes, right? And again, previously, we had no criteria for actually what an anomaly was or how to measure it, how extreme or severe that might have been. So by defining some criteria, we can make sure that we're regularly able to detect changes to funds. And then the other thing, this more or less occurred at irregular intervals. So like I said, it was more or less on the analyst to notice that something had changed, then go impact and take action on that. So by us automating these checks, running it at regular intervals, in some cases daily, in other cases monthly, um, it really is helping solidify some of that system. And then the last thing, like I said, there's a large number of strategies to review. We have 90,000 rated strategies, or you could think of this as multiple funds that have similar investment theses, and only 3,200 of those are actually analyst covered. So that does port to about 30,000 funds. But by giving a clear set of or a clear number of strategies and which strategies to review, that obviously helps them focus their time. So getting into some of the requirements of this project, right? Immediately, it was very important that we didn't have some black box, right? And we did experiment quite a bit with unsupervised machine learning models, and actually that's where the name of this talk comes from, what to do without enough data. So in most cases, we had monthly data, and that was maybe a 10-year history. So at most about 120 data points to train a machine learning model on this specific fund's individual history, which over time did not yield strong results. And so that's ultimately when we came back to the drawing board and really honed in on statistical approaches and rules-based approaches. Specifically with rules-based approaches, I'll talk about manager change, and then specifically with some statistical approaches, my colleague Mike Avens will talk about performance anomalies. Now, still hopping back to some of the key things here, though, like I said, it has to be repeatable. And ultimately, we would like it to be quickly and easily adaptable, because if some criteria that we have set up doesn't actually work for detecting anomalies, we should be able to change that relatively quickly and easily. And it was also very important that we had different levels or severities of these anomalies. So I'll take that manager change as an example real quick. A manager who just joined a fund, immediately leaving, is probably less severe than the person who's been on that fund for 25 years and suddenly leaves without any warning. So quantifying how severe of an anomaly actually occurred was important, and that's where we came to this trivial, noteworthy, substantial, and extreme levels. And because we needed to be able to consume feedback, we generally had four buckets for which our analysts can actually provide feedback. Ideally, every trivial anomaly is only ever nice to know. Ideally, every noteworthy anomaly they are they may take action on. Ideally, every substantial anomaly means that they're likely to dig deeper or engage with the actual fund managers. And then any extreme anomalies should only um, trigger this likely to consider ratings change. And then noise and false positive is data errors and things like that. Um, yeah, and then this I'll just quickly touch on. It's a visual of all of the different anomaly detection projects that we actually track. So within the parent anomaly detection space, we actually only have 5 events here. But then within the anomaly detection, there's 36 different events that we track, and that falls into different buckets based on asset class, um, investment strategy, so on and so forth. Getting into our workflow a little bit, the overall process that we aimed for was that we would be able to take Morningstar's data, since we are a data company, uh, to build these different anomaly prediction models, recommend anomaly events for our analysts, who then are able to review, and based on that feedback, we are actually able to update this decision making. Also important to think at this stage, what we didn't recognize as an anomaly is just as important as well. So I'll go ahead and pause here real quick. Are there any questions so far?
Just feel free to type in your questions or I will unmute. Uh,
It looks like we do have a question from Ella.
Yes, hello and thank you for presentation. Actually, this workflow is a general workflow or for anomaly detection or just for this case usage? Um, yeah,
So yeah, this is specifically I mean it is specific to our use case. I wouldn't say it's necessarily wholly generalizable. Um, but I think this kind of workflow could be implemented elsewhere, definitely.
and would you please give anomaly prediction models like with few data, like which models
Yeah,
are applicable?
absolutely. Hmm.
Yeah.
Yeah, so um, like I said, a lot of what we're doing is rules-based and statistical approaches. So like the term model there is like building out this rule set is a model for predicting anomalies. Specifically, to answer your question a little bit further, I'll hop back to this slide. The rules and statistical approaches. We did explore, like I said, some unsupervised machine learning methods. Unfortunately, because, like I said, at most we had about 120 data points. Uh, I'll actually, we started with isolation forest, um, angle-based outlier detection or ABOD, and a couple of others. But like I said, unfortunately, those weren't necessarily the results we were getting from there weren't as repeatable as we would have liked, um, especially given that each fund's history was the it had to be both the training and the test set. Um, but yeah, uh, I see a couple questions in the chat. The first question I see is, so what is the kind of data used for model training? Like I said, it's not specifically, um, or it depends actually on anomaly event, given that we have so many different ones. In some cases, it's historical returns. In some cases, it's historical movements within like size score and things like that. And then the last one, see here, is if there's any outliers in your data, i.e. they're missing, or you only use. So long term, we definitely do have plans for, oh, sorry, I gotta blow this up a little bit. It's so yeah, for outliers, sorry, it took me a second to read all the questions. So starting with if there's any outliers in your data, i.e. they're missing, are you only using a statistical approaches to fill? So actually, in general, like with missing data, we aren't trying to fill. A lot of the data that we collect is reported data. And so if it's missing for some reason or another, we as in most cases we assume it's because it should have been, but also we have different reporting structures. So in some cases we do have that monthly data where that fund manager is reporting every month, but in other cases maybe they're only reporting quarterly or once every 6 months. And so in cases like that, we definitely had to adapt. And then how do we identify anomalies based on thresholds such as 3 standard deviations? In certain cases, yes. And so specifically for this equity fund specific data under this portfolio arm, it's definitely looking at historical values, coming up with a z-score, and then looking outside of those 3 standard deviations. I think in some cases it's actually closer to 3.5 or 4. But yeah, it's based on the specific event as well. Oh, and I see Mike's in there answering questions. Thank you. Yeah, so in general, the stats models that we've used tend to be more like that 3 standard deviation threshold. Like I said, of the different ones that we had tried, like isolation forest and ABOD, didn't necessarily yield the results that we were hoping for. But yeah, let me go ahead and hop ahead to this manager change specifically. Hopefully it'll give you guys a little bit more context for, in some cases, how we actually have to identify these anomaly events. So just getting into a data set that we can actually use and analyze. So the manager change anomaly event, ideally, I think it's especially interesting because ideally, no analyst ever takes action from the anomaly that we send them. Specifically, what I mean by that is since manager change is defined as any change within the underlying management structure of the fund, people being one of those pillars there, any change is important to alert the analyst to. And traditional detection has come from SEC filings. So a little bit about our data factory. When we get an SEC filing, it takes about 3 days for it to then be consumed and hit our databases. So ideally, by the time we've detected this change, the manager research analyst should already be aware and have impacted some change, but that's not necessarily always the case, right? And especially if they're unaware of, or if they're aware of one person leaving, but maybe not another person joining, so on and so forth. really important that we send this information to them, correctly bundle that, right? So we start off with some table in SQL that contains person ID and fund ID, and those are the unique keys of that set, as well as a start date and an end date, right? So that means that for each individual person, we know how many funds they were on, what time they started on that fund, and what time they ended on that fund, right? Now, this becomes more interesting because we can also have changes, like especially outside of the US, that don't hit our databases immediately. So we can have things backdated potentially years. That's typically not the case, but typically within 3 months would be a solid range that I would say. So we have to be able to not only capture changes, but we can't rely on the specific dates here. We have to more or less rely on daily caches of this database to then merge and compare with the new version of that table, right? And so how we actually break that out becomes this really interesting logical flowchart here, where ultimately we could have all of these potential different change conditions. But ultimately, it only comes back to a manager was added, a manager left, or there was no change, right? So how do we actually think about detecting anomalies with this? Well, two of the data points that were really important for us to calculate was the individual fund and industry tenures of all of these managers, right? So with whatever start date we have, if no end date is provided, then we can use the current day, assume that they're still on the fund to calculate how long they've managed that fund. And similar, since we have all of the funds that they've ever been on, we can calculate industry tenure using the first start date for each person ID, right? And those end up becoming some of the core structures for actually setting up our rules. So getting into those rules a little bit, maybe, there we go. We get to the point where we roll up to the specific fund ID, right? And we have the number of managers that were added, so that's the count, their average fund tenure and the average industry tenure, as well as the managers removed and static managers. So these are the managers that don't change, and we have those same data points for each of those buckets, right? When we actually think about setting up the rules, in general, we try to compare the average tenures to each other, and based on that disparity, it can speak to the gains or losses in experience under a specific fund. So as an example, here, we say that this is a trivial anomaly if the managers that left have a lower average tenure than the managers who didn't change at all. And on the other side of things, the industry and fund tenure, sorry, in the case of a manager being added, it's actually a unique case because we can't necessarily compare apples to apples, since if we're thinking about fund tenure, these managers don't have any fund tenure, right? So as a proxy, we're actually using their industry tenure and comparing from there. And similarly here, if this manager has, or if the average of the added managers is less than the static average fund tenure -5, we're denoting that as trivial. And then as you can see, we just kind of incrementally gauge up as we go. So these extreme alerts ultimately are, like I said, what we've considered to be the most severe. And so if the average managers that left have 10 years more experience than the managers that are still there, that's extreme and worthy of them at least reviewing that manager change. And then I'll just say here, ideally, we would like to see kind of a half normal distribution here. So obviously, normal distributions require continuous, and categorical isn't necessarily the same. But what I mean by that is ideally, we should see this none type always higher than the amount of trivial anomalies. Noteworthy ideally is always slightly less than trivial, substantial less than that, and then extreme less than that. These are the counts of anomalies that we had, I believe, between August 30th and September 31st. August 31st, September 30th. But yeah, and then getting into how we actually communicate this to analysts. We wanted to describe this in terms of a blurb or some sort of text, because just saying, oh, it's extreme because this average is greater than this average isn't necessarily the best way to do that. And so as a couple of examples, we put together this sort of robo-text as a way to describe that to them, right? And so you can see here, this was a trivial anomaly because this fund had this manager added to the fund, and you can see that they've only been in the industry for about 5 months or so, so not necessarily a wealth of experience. And then you can see of the managers that are still on that fund, this person had 21 years in the fund, almost in the industry. So this is not a big shakeup to that management structure. Another example here is a little bit more of a shakeup. Again, a manager being added, they bring 5 years of experience within the industry. But again, here we see these managers have both been on the fund for about 9 years and have a wealth of experience within that industry. And I'll just talk through one or two more of these. I've got more than we probably need to go through. But this is, again, an interesting, this person left the fund. They had 22 years of experience. Now you can see here that this other manager, Jonathan, had just as much experience on the fund, maybe even a little bit more. And Trevor here also has 15 years of experience. So them losing 1/3 of this is not necessarily as big of a deal as if all three of them had left, as an example. And then as I go through these last couple of examples, really what I do want to call out is this section for feedback. So that way, not only are we consuming the raw feedback we get, but we can also dive into that a little bit deeper and really understand what is going on. But yeah, that's my section. I'd actually like to turn it over to my colleague, Mike Avens, to discuss performance anomalies. So Mike, over to you.
Yeah, thank you, Quentin. I'll take it away. Hi, everybody. So my name is Mike. I was born and raised in Russia. I finished high school in Singapore at United World Colleges of Southeast Asia. In the spirit of Halloween, this is me yesterday wearing a pumpkin. I finished my college at Lake Forest College in Illinois, and now I've been at Morningstar for about 9 months. I started on the team with Quentin. Quentin used to be my team leader, and now I switched over to quant equity research. And the performance was one of the anomalies that I did for that project. So actually, that kind of brings us to the next topic, and that would be the background on the performance anomalies. Quentin? Thank you. So I'd like to provide a little bit of a background on performance anomalies in mutual funds and the challenges we face when we're trying to identify them. So first, let's define some key terms. Excess return is the difference between a fund's return and its benchmark return over a specified period of time. It tells us how much a fund has outperformed or underperformed its benchmark. Tracking error is a metric that represents a standard deviation of the excess returns over a specific time horizon, and it measures the consistency of a fund's performance relative to its benchmark. And kind of essentially, we're trying to capture the volatility of those excess returns over time. And a benchmark is a standard or point of reference against which financial performance can be measured. And again, as Quentin mentioned before, S&P 500 would be an index that can be used as a benchmark, or we have our Morningstar grown Morningstar category indexes. And those are kind of the specific sets of assets that reflect the market or particular segments of the market. And now we getting to the problem. So let's say we have those metrics. However, despite having these metrics, we encounter two quite significant issues. First is how do we define an anomaly? As within the vast number of funds and the different types of kind of risk valuations of those funds and the varying performance of each of those mutual funds, we need to somehow determine when a fund is genuinely having an unusual period or something is happening with its metrics. And that's quite a complex task to actually grasp, since again, you have different types of funds, you have different methodologies that analysts apply when looking at them, and the portfolio managers themselves, they have different strategies. So it's quite hard to create a solution that works for everything, and that kind of brings us to the how to create a common rule. And funds employ different strategies, there's varying risk levels, and it's kind of hard to select a one-size-fits-all approach just because it most likely will not work. So these challenges kind of highlight the need for a very robust methodology that can accurately detect performance across diverse investment strategies. And that will bring us to the portion of how do we actually create the methodology. So the methodology was always is being created as a process of experiments. We began by developing an initial framework that compared excess returns to the confidence intervals that we derived from the tracking errors. So recognizing the need to capture both sides of the anomalies in short and long time frames, we decided to kind of split our analysis accordingly between 3 months and 1 year, so which is a quarter and a year. And on those two graphs, you can see the kind of spread of the tracking error compared to the excess return. And so we compared those 3 months excess return and 1 year excess returns against the confidence interval from the 3-year tracking error. And this comparison gave us the insurance that we are accounting for historical strategies volatilities. And to get the viability of the approach, so you come into the problem with the kind of first gut feeling approach, where I think that statistically seems correct, that is logical, and that sounds and looks like a good thing to do in this specific scenario. So now we have to verify this approach, and to do that, we engage with our team of analysts. We showcase our preliminary methodology that we developed. We walk them through the statistical models, the rationale behind our choices, what assumptions were made, what things were accounted for, and they provide us with the insights into the nuances of investment strategies or how they think that should be structured, since they're experts in the field, and they kind of help us understand how our models perform in the real world scenarios, specifically for like a little sample or subset of the strategies that they're experts in. And the more you talk to analysts, the more you kind of can expand and generalize your approach. So based on their feedback, that's what we do. We adjust, we fine tune our confidence levels in this case, or the parameters of other models to kind of better capture the anomalies that correspond to what analysts truly believe to be an abnormal performance of a mutual fund. And that kind of brings us to the next portion, is the statistical analysis we do. So we've created the initial methodology, we vested that methodology with our analysts, and they gave us a go-ahead. So now we check whether our models and our methodology truly align with the statistical expectations that we have for the specific anomaly. So in this case, you can see two graphs that represent the anomaly severity, and they represent the flagging with the true or false. Is it an anomaly or is it not an anomaly? And there's quite a very unique portion where you can see that the anomaly severity between true and false stops on the 1 mark, and there's a reason behind that. And feel free to ask questions. I'm not going to go in depth on the methodology right now, but feel free to ask questions about that later. And then again, we can also see how the anomalies are being spread over different categories and broad category groups. We can see that most of the anomalies that are happening is inequity, and we can also see that the alternative portion is swaying up and down quite a lot. And surprisingly, fixed income is also coming up there, but that's how we do anomalies. We see that things are different from what we expect them to be, and the statistical analysis kind of helps us to determine what exactly is happening. And again, I also put together little kind of comments that our analysts do on the anomalies that we provide them. And this is, for example, one of them. We have a noteworthy quarterly performance anomaly on the UK mutual fund with the quarterly excess return of negative 1057, and the benchmark was performing at 788. That clearly is a big discrepancy. And by the way, the 91th is a typo that was fixed. It's just a little thing that robot texter does it, but that was fixed. So clearly that's an anomaly. It looks like it is. Something's happening, and then that anomaly was shipped to the analyst, and the analyst said that they may take action if the anomaly persists, and they're going to have a meeting with the fund manager in November to discuss what is happening with the fund. And another example of anomaly would be a substantial quarterly performance anomaly. Here again, it's not that big of a discrepancy, so it is substantial. And it's nice to know for the analyst, and then they are kind of expanding on why they think it's happening and what is the kind of underlying reasoning of the fundamental analysis behind that on top of our numbers that we're running. But yeah, so that brings us to the final portion of our presentation is a Q&A, and please feel free to drop it into the chat, and I'll be happy to take over the chat questions, and while Quentin is answering them over voice or vice versa, whatever works, please feel free to ask questions.
I see there's a question in the chat from Alex Kappen. I'd also like to invite people to raise their hands if they want to ask a question verbally. But for now, I'll just read that out for people. So Alex says, for the true anomalies that the model fails to detect, how do you update the model? For example, if the model doesn't raise an alert for an anomalous fund, then it wouldn't go to the analyst for review, which would mean that the model wouldn't get feedback that it missed the anomaly. In other words, how does your team do the review activities step of the process so that you can incorporate those missed anomalies?
Yeah, absolutely. And I think the biggest thing that I'd call out here is that's why we need severity types, right? So by setting this threshold or setting some of these lower thresholds, what that means is how trivial anomalies are viewed is ultimately informing some of that. So if as an example, a trivial anomaly, like I mentioned initially, should actually never be the cause for a ratings change. And so all of a sudden, if it is the cause for a ratings change, really what that's telling us is that something with that rule structure is incorrect. And so really it's looking to see if there's alignment within how we're classifying anomalies with how they're actually being interpreted by analysts. Like I said, if there's some big disparity there, that's kind of the key in for us to take a deeper look and look at some of those other things as well. Yeah. Mike, is there anything that you'd throw out there to that, or?
Yeah, as I mentioned before, we usually try to stick on the conservative side, just again to avoid those cases where we have an anomaly that slips by us, and the more we run it, and the future kind of expectation is to improve our models by implementing that analyst feedback. So the more that is going to keep happening, the better and better our anomaly precision would be. And again, unfortunately, if the numbers don't align and it just doesn't get flagged, usually it's not the, at least specifically for those two anomalies that we've covered, it is not the reason for them to be anomalous. And again, as Quentin said, we do have the categories, so that helps as well. I see William with the next question.
Yeah, thanks for the talk, guys. So I'm sort of thinking, like, generally speaking, your architecture, like the models you're using, are mostly sort of rule-based, constraint-based type stuff. Is that correct?
Yep.
Yeah.
Okay, so I was doing a project on a company a while ago where we were trying to do anomaly detection based on time series data, and they sort of had like fluctuating data points from different sensors and stuff over time. But they also had very sparse like anomaly data. And part of the issue we had was we were trying to use models that could use that time series data, like gradient models and random forest and all the black boxes too. But we had the problem where a lot of the anomalies we were getting weren't aligning with what the company was looking for. And part of the reason we couldn't do it so well is because extracting the constraints from their subject matter experts was really difficult. Like in an example, like you guys are talking about, maybe where like you can classify into bins, sort of like, okay, like if a manager leaves with this experience, that's this level of problem and other stuff like that, right? It's a bit more like discrete. Whereas we were trying to like handle very complex patterns with a lot of different sensor variables. So I'm curious if you guys have any ideas like in situations where you don't have such clear rules that you can get directly from subject matter experts. Like how do you actually begin to build a more like robust system that produces real like useful anomalies from that?
I'm happy to answer that, Quentin, if
Oh,
you
if you want to take the first stab at it, I was thinking of how best to, but yeah, go ahead.
Sure. Yeah. So the problem of not having a direct kind of ruling or whatever specific steps to take with this, let's say we're talking about a mutual fund. Let's say we have a strategy that nobody's covering. We don't know what's happening. We're fortunate enough to have analysts that we can extrapolate and interpolate the information that they give us. So let's say we have a similar fund that actually is being rated, so we can cross that over. So that's one way to kind of solve that. And the second portion of the that issue would be um, us not. You can't. Unfortunately, you can't really have a true apples-to-apples comparison for most of the mutual funds. And what brings it brings you to the point where the only thing you can compare to is the fund to itself. So its prior history of returns, prior history of sell books, or whatever metric we're looking at. Um, some of the funds are a category in and of it themselves. So for example, the performance anomaly, how that works is that you're looking at the historical tracking error, so 3 years tracking error versus their own excess return over the 1 year and 3 years. And again, those are two different periods of volatility, so we do account for the square root of time rule, and our confidence intervals are being scaled accordingly to the difference in risk. So usually kind of those are two cornerstones of our approach. We either have analysts that have rated some similar strategies, or you don't really have anything that is comparable, and all you can do is compare it to itself, to the historical performance, and run the statistical analysis on what is happening out there. Quentin, if you have anything to add to that.
I mean, really the only thing that I'd throw out is we were really, really fortunate that we had a strong set of subject matter experts who were not only willing to review some of the results we were looking or potentially had, but even call out anomaly events that we should be detecting. And so in some cases, that's obviously not enough for a full baseline. But it was enough to guide us in certain situations to help think about the creation of those. I don't know if that answers your question fully, but yeah.
Yeah, it sort of seems like a big part of it is getting a lot of buy-in from your analysts. And that's definitely something we struggled with because we only had so much time with them, right?
Yep, absolutely. Yeah. Um,
It's nice
All
to
right,
have
thanks, guys.
knowledgeable people on the speed
yeah,
dial.
absolutely.
It's always a good thing.
Without a doubt.
There's another question in the chat. Basil says, how do you define your 1 mark threshold when you say anomaly flagging stops at the 1 mark in statistical analysis?
That would be with this slide, correct?
Yeah. I I would assume so. So the 1 mark, so it's the severity levels. So what is a severe? Specifically for the performance anomaly, the anomaly is structured in a way where we look again at the historical performance. Let's say we have 3-year tracking error, and we're creating a confidence interval. So how confident are we that the excess return will go outside of this tracking error if we increase it to the standard deviation of, let's say, 90%. So you multiply by, what is it, 1.645. So you multiply the tracking error by the confidence interval that you think is going to not go over, or whatever the credibility you give to this specific tracking error. And you say, okay, so this fund historically should not be coming outside of those boundaries. And if it does, we might have a problem. And the question how severe the problem is again dependent on the categories that we provide. So if your fund is within those confidence intervals, which is the severity of 1 or lower, you say, hey, we are expecting this thing to be within those kind of boundaries, and we think it's not anomalous. So it's, again, the severity of being 1.0 is 1 mark is, again, due to the way it was set up, where we know that if it's within the boundaries, it's not an anomaly. If it's above 1, we know for sure it's an anomaly, and that 1 is a severity. It's not specifically a confidence interval, but that's a severity ratio where you have the how far away it is out of the confidence interval divided by the confidence interval itself. So that's how it gives you 1 and above is anomalous. Hope that answers your question.
Okay, and I think we probably have time to answer one last question from Lisa, who asks, how do you finalize the number of classes that you classify the anomalies into?
Yeah, so that was actually largely a top-down decision, but the basic idea there was just that we needed more than one bucket, right? And so kind of trying to find the best like number to use. Like 4 kind of became our sweet spot, right? 3 still seemed like it was a little too few. And so 4 specifically is what we use because there's the noteworthy, substantial, and extreme are the ones that we think that analysts will want to take some note of, and trivial is more or less like here's the just in case alert. And so really the decision was these 3 make sense for the higher sense of buckets, but we need one more bucket to make sure as our catch-all. Yeah, I hope that answered your question.
Okay, with that, I'd like to thank our speakers. It was very cool to get an insight into the sort of sophisticated statistical analysis that's going on as part of your work. Thanks everyone for joining us this afternoon. Samaya shared some links that you can keep an eye on our future seminars and social media. I saw that Quentin shared those QR codes. Hopefully you got a screenshot of that. And
Let me share
yeah,
that for you guys
yeah,
again.
just maybe for the last couple of minutes, if anyone else wants to get a picture of those, just to follow them further.
Yeah, and
So
feel free to reach out to us if you have any questions or anything about what we talked about today, or any questions about what Morningstar does as well. Happy to answer as best as we can.
Yeah, if you have any great ideas about how to detect anomalies, please let us know. We will be incredibly happy to listen to what you have as your ideas, and definitely might implement them actually if they're great.
okay, so thanks again to Quentin and Mike. Thanks for everyone who attended, and yeah, happy Halloween.
Thanks, everyone. Take
Thank
care.
you.